Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. Well, when we mentioned this show about 3 or 4 days ago, a lot of you have written to us about wanting to know what the content of the show is and have sent us queries. So we'll try and answer all of those. But the next 25 minutes, we'll tell you all about how you can retire, maybe even retire rich by the use of mutual funds, and what's the need of adopting this route in order to have a good retirement life. To talk about that, well, two experts, Radhika Gupta, CEO at Edelweiss AMC, and Subramanian, blogger and author of Retire Rich, join us on the show. Well, couldn't have had a more perfect pair. Thank you so much, both of you, for joining in. Well, ladies first, let's start with you, Radhika. You know, a lot of millennial audience will be watching this, would be thinking that, hey, we believe in living for the moment. Why plan to retire rich? Let's live in the moment right now. It's really funny, actually. You know, we did a survey about retirement with a group that ranges from millennial to old. And most people know that they have to retire, but what it means to retire, people are quite clueless about. And I think a lot of people ask this question, why should I care about retiring? And I think there are three answers to it. One, to your millennial point, you know, the years you're going to spend in retirement are going up. So when my father retired, he retired at 60. And life expectancy was 80, 85. So he spent 25 years. He is spending 25 years. The average millennial wants to retire at 45, 50. He's probably going to live till 90. So he has 40 years of retirement life. So that's one. I think the second, which is interesting, is that we in India are moving from joint family to nuclear family. So 70% of people say my kids will support me in retirement. I think 30% of people's kids actually do. So that reliance on someone else, I think, is going down. And then finally, inflation is a big deal. So I was just checking this again. I think the cost 30 years ago of most things was 1/6 of what it is. Amul butter is actually 20 times as expensive as it was 30 years ago. How did you come up with that example? But okay. Because we all use Amul butter, right? Sure. We live and love Amul butter. And it's not just basic inflation. You know, as you get older, you want more comfort. So that whole element of lifestyle inflation that creeps in. So these three things coming together just tell you that retirement is something you need to look at, because you're going to spend 35, 40 years in retirement. Yeah, maybe more if people are health freaks like I am. But Subra, one other thing is, and something that a friend had told me when he got a kid, Neeraj, I have to plan for two things: education, medication. Education for my kid and medication for myself. Correct. And I think that's one very big thing, right? Planned medical expenses, unplanned medical expenses, both. Yeah, especially the planned medical expenses, you go and get yourself insured. Yes, Mediclaim, insurance, whatever. Some kind of an insurance. Whereas given Indian conditions, you don't have something called long-term care insurance. So if you're going to stay in a senior citizen place and you're going to pay for adult diapers and daily nursing and all those things, we don't even estimate those costs. When Radhika spoke about costs, I don't think any millennial will even think in terms of old age support costs which will be there. And those are inflating at a far higher number than 3-4% which you read in the press. So children's education, yes, it's getting expensive, and people want branded education also, so that is expensive. And like you said, old age costs. And where are you going to stay in your old age? Senior citizen home, gated communities, all that cost money. And we have no surveys, we have nothing which we have done to estimate these costs. Okay. So, well, if that doesn't scare you into planning for retirement, I hope now, you have done it. So let's try and go this step by step. One is identify the need for retirement. And we borrowed a lot of this data out of, Radhika, the stuff that your team gave us. So let's dwell on that for a bit. Just quick summation through some of those numbers. Identifying the need for retirement. A 30-year-old, and we're just using this as an example, it could have been 40, it could have been 35, it could have been 28, doesn't matter. But a 30-year-old, just for argument's sake, spends about 40,000 a month currently, give or take. That's the average cost would be. How have we come at these numbers, Radhika? 80% of expense on retirement at 60, it's 32,000 per month. And therefore, the numbers, because of inflation and compounding, because even expenses compound, reach a staggering number. Yeah. I mean, so we just took that 40,000 rupees a month and said conservatively, as you become a little older, some of your spending on gadgets, etc., comes down, but it's compensated by healthcare. So we took that 80% number.
7% is actually a very basic rate of inflation. I mean, the reported inflation, as he said, is 3-4%. You add lifestyle, plus you add medical, plus you add education. 7 is actually a pretty conservative estimate, and 10% is the long-term return on an equity plus debt portfolio. And then the numbers at 40,000 rupees a month, when you see 5 crores, then it becomes a staggering number.
So you are saying that a guy who's 30 or a lady who's 30 right now will need a corpus currently for 5 crores, or will need 5 crores when he or she is 60?
When he's 60,
will need 5 crore rupees to lead a basic life that he's leading right now.
Yeah. Because imagine how many years you're going to assume 30 years in retirement, right? 25 to 30 years in retirement.
Yeah.
Plus inflation.
Okay. And do your numbers become scarier as well, Subra? Because you would have seen...
He calls it the time bomb, right?
Yeah, I call it the retirement time bomb, because one, this 40,000 does not include even a vacation to go out. Look at it this way. This does not include your foreign vacations or things like that. There's hardly a vacation to go as what is included, assuming you're staying in Bombay. So you add one of those things, you put in some education, then this 40,000 goes for a toss.
Okay.
Secondly, your house has a life of maybe 25, 30 years. So assuming you buy a house at 45, at 75 you may have to buy another house.
Sure.
And what happens if you live till 110 instead of 190? Right, so you have to provide for that extra. So I think 5 crores is very conservative. I would put the figure at something like $1 million.
Okay.
A house plus $1 million.
Which is about 7 crores,
This 5 crores does not include the house in which you live. So you have to remember that. This is just the cash assets that you have. This does not include your golf kit or cricket kit or any of those things. That is for fun.
Sure.
This is the cash which is working to pay for your expenses. The money in the bank or mutual funds or equities or something like that. That money has to be 5 crores. Over and above your house, car, golf kit and all that other things which you have.
Just the basic need, just the basics that need to be put in. Now, just before we move on to the next piece, I just want to remark, Radhika and Subra both spoke about life expectancy and how the numbers would vary if indeed you would live 15 years longer. And I hope you don't curse yourself for living that much longer, because you should aim to live longer. But look at this. 2 examples, Rohit and Suhas, again, arbitrarily chosen names. Age 28, retirement age 60, monthly expense similar. But if life expectancy gets changed from 70 to 85, with the same inflation and the rate of return, the corpus required changes so dramatically. It's a 50% bump up on the corpus required at the age of 60 to just sustain the basic life. So now you know, and if we haven't scared you enough, there's more coming up. But this is not really about scaring people. This is more about making people aware that you need to start planning for your retirement now. Today is the day, the moment when you start planning for your retirement. And maybe mutual funds could help you do that as well. So, the interesting thing is also on a lifestyle-based asset allocation, the debt equity allocation, and how people should have that in order to make sure that that allocation is correct in order to have a better retirement. You want to dwell on that a bit, Radhika?
Sure. So I think one of the things, and we saw it in our survey also, people don't know, should they do debt, should they do equity, what is even asset allocation? I mean, the term is thrown around a lot, but the awareness of it is actually very limited. See, when you're early, like you take that example of someone who's 30, you can take a lot more risk, which means you can hold a lot more equity in your portfolio. You're 30, you're planning for an outcome at 60. So you can enjoy 30 years of equity compounding. However, and the chart is saying this too, as you age and come into your 60s, the amount of fixed income you hold needs to be much higher, because your time horizons condense so much. So ideally, that journey between 30 and 60 needs to be equity falling and debt rising. That is essentially age-based asset allocation. And that's very, very critical, because that will ensure that, one, you have a smooth journey without any heart attacks. You have the liquidity at 60 when you actually need to start taking that money home, but you earn that return that is going to beat inflation, because that's the core objective out here.
Okay, and keep in mind, I'm an out-and-out equities man. I talk about markets every day for a living, so I would probably believe equities is a thing to go to. But Subra, the important point is that people who are 30 or sub-30, when they're starting off, should have the courage to go out and park in whatever number. It could be 80 as per as Radhika, it could be 70, it could be 85 as per your thoughts, but should have that courage to go out and park into equity, because over the long term, equity will have a better chance of giving you the return that you have, right?
Absolutely. See, I think it's more of training them a little bit in behavior. Because a guy would come and say, no, my father lost all his money in Harshad Mehta scam or something like that. So he's very scared to invest. So somebody has to handhold and say, don't worry, you put the money, see how it works, and then you can bump up. Like, for example, mutual funds allow you to increase at, say, 10% every year. So first you start with 5,000, next year it can be 5,500, and you can slowly bump up and then see what is the impact. But if a person gets burnt, if a person entered the market and the market falls 30% or something like that, it'll take him a long time to come back into the market. So you have to just pray for good times when you start. Later on, if you're started at 25, at 35, if there is a bad market, you say, okay, 10 years, I've seen what has happened. But you start at 25 and the market is bad, you get
what do you tell such people? Because I'm sure for somebody who's coming to you right now, let's say you believe that the market is overvalued right now, and somebody's coming to you for advice right now as to should I start planning? You obviously tell the person that yes, because you have 35 years of whatever, or 25 years of equity life left. Start now, even if the markets are slow, go buy an SIP.
Yeah,
that's the standard advice, right?
Absolutely.
So even if the returns were to be lower in the next 2 years, it's better to start right now.
In fact, I think the last 25, 30 years has spoiled us to believing in some 18% kind of return. Because if you see, that is what has happened.
Yes.
That's luck. You need to know what has been luck and what has been skill. This is just sheer luck. If you've been there and you've gone up, it's like you were sitting on a rocket without even knowing it's a rocket. That has happened, already happened. So to expect that is wrong. So your expectation has to be something like 12, 13%. If you do better than that, great. But if you don't do well, it means you have to put more money. Remember one thing, your ultimate aim is to generate that 5 crore corpus. So if your return expectation is 12 instead of 18, obviously you have to pump more money. You have no choice on the goal. The goal is 5 crores.
Okay.
So if you don't have a bare minimum. So if you think you're going to get 18%, you get more confident, overconfident, and you put less money, and then you find after 3-4 years you've got 12, you need to bump up the money rather than shouting at your advisor, "Tu matra bola tha 12 mila hai." He's not creating it. The market is creating the return for you. So you have no choice. You have to handhold. You have to say, yeah, hold on, SIP kar rahe ho. Even if the market is high over next 3-4 years, just hold on and things will improve. That's all.
Okay, that's important. And if you have an advisor who will be able to handhold you and guide you, saying that, okay, now that we spent a year and a half within these SIPs, let's go out and increase the amount, great. But otherwise, now I think funds have started coming out with this bump up option built in as well. Radhika, you've launched a thing like that recently as well. Can you talk a bit about that? Why is this bumping up important?
So what we've done is, we've done exactly what Subra said, is that we've launched an SIP feature. We call it the retirement plan. And so you do an SIP, and there are two options. So there's an auto and a custom one, and I'll take a minute to go through this. So in the auto option, which anybody can choose, you pick an equity fund and you pick a debt fund from any of our basket. You pick multi-cap, basic bond fund. At 30, it will be 80-20, aggressive equity, conservative debt, because that's where your life stage is. As your age keeps increasing, it will gradually shift to the SIPs being more debt oriented, so that by the time you're 60, you actually come to a 50-50 based allocation, and in between the portfolio will rebalance. After 60, by the way, it will let you do auto withdrawals. So you can choose the amount. There's also a custom option, by the way, where someone, I say 80-20, that works for me. You can choose that at 30, listen, 80-20, I'm not comfortable with. I want to start with 60-40, and I want to end with 20-80 the other way. So there's a custom option also where you can do these SIPs, but the idea is to do age-based allocation and to let someone do it automatically, because as he said, behavior kicks in and that prevents us from doing things that are naturally probably good for us.
Okay, and also the other bit is a very nice math again, which speaks about how the bump up might aid. So if you're investing 10,000 per month for 35 years at 18%, which is staggeringly high, but let's work with an assumption that it's 18%. Let's make you feel good as well. Then if you keep the SIP amount same throughout, then the value of that investment goes up to, well, about 2 crores, 2.17. But if you increase the SIP amount by 10% every year, auto 10% every year, then the value of that investment goes up to 45 crores.
And Neeraj, you will.
That's the staggering difference. Sorry.
Your income is going to increase. I mean, you hope that with life, your income increases. I mean, Most of us hopefully get increments that are 5 to 10 to 15%. So it's actually, it seems staggering to increase it by 10% a year, but it's not actually.
Yeah, well, incomes increase, savings increase, you probably better plan your expenses. Is that something that happens as well, Subra, in life? People, even if the incomes may not grow at a very staggering pace, they're able to plan their expenses better, because at 25 you don't quite understand the importance, but maybe at 35 you understand the importance slightly more.
True. Actually, I am finding girls getting smarter in investing, in the sense
Not
that...
surprised.
No, I'll tell you why. Because a girl is happy taking money from her father's purse for whatever she wants. Then let's say she starts earning, she gets married, and then she takes a break for 2-3 years to have a kid. She's not at all comfortable taking money from her husband. She needs her bucket. So I keep telling them, retirement does not happen in only one stage. It can happen. A 3-year break is a retirement. Then again you take a 2-year break to nurse your father, mother, mother-in-law, father-in-law. Largely nursing is done by women, 90% of the cases.
Sure.
So those are times when you need money, when you're not very comfortable asking anybody else, because you've always earned your money.
Sure.
So girls need this retirement dabba much earlier, so that they can keep withdrawing a little bit and then have a lump sum left by the time they're 60, 65. So it's happening. Girls are thinking like this, and investing is happening that way.
Okay, so 2 or 3 things from a mutual fund perspective. You would be asking, we are doing this a bit of a personal finance kind of a show on the mutual fund show. Why? The idea is that if you believe that equities is a good, powerful tool to make you money, then the quantum of allocation at different age brackets, and that's the chart that we showed, is very, very important. So by and large, these are standard proven processes. So maybe you too could stick to these processes and these numbers. So that is one thing. And you need to start early, and maybe, just maybe, you need to have this bump up plan, whether you're investing yourself in equities or doing it through mutual funds. If you're not a regular equity watcher, you need to have these bump up plans as well. Now, for a lot of our younger audience who are just started to earn or in college, etc., and having this really nice lifestyle, because friends tell ke abhi to ji le, baad mein kamana hi hai. Here's one more example of what happens, the benefits of early saving. Radhika, you want to dwell on this a bit? Subra, you could dwell on this as well. A couple of examples. One is on money spent a month on shopping, and what could that do to the life and savings, and money spent a week on restaurants, and what could that do to life and savings. You start off with the shopping thing.
No, I'll start off with the restaurant thing. So
really?
one weekend I posted a tweet on, if the 2,000 rupees that you spent on restaurants every weekend, assume you spend 2,000 rupees, if you put that much money into just your savings, then the amount you get between equity and debt, it's flashing on your screen, it's in crores. So a lot of millennials came back to me and said, are you advocating that I stop eating out?
Yeah.
But my point is that you have those 30, 40 years. Retirement is going to happen. It's inevitable. You have to live through those 30 years. So if you can just take away that 2,000 rupees, which you would spend like this, and put it away, then at least you have started the problem early. If you delay that problem 15 years, then instead of putting 2,000 rupees, you'll end up having to put 20,000 rupees, and the problem becomes gigantic.
Okay, so maybe don't stop eating out completely. Do it on alternate weeks or alternate weekends. Maybe that's one option too. It need not be as radical as stopping it completely. But these are simple examples. Regular expenses which happen. If you think you can control them and put that money to good use, into funds, into normal savings, then they could go a long way, because you start early and you enjoy the power of compounding that comes in over a period of 10, 15, 20, 25 years. Subra, similarly, on shopping as well, it's a people
fact,
call this a retail therapy, and I need it very badly.
No, I think retail therapy is it's a way to fool women into shopping. Men are not told about retail therapy. Men are bought Lego blocks and asked to build. Women are given Barbie dolls and handbags and said, go shopping. So I think
you're not being
it's a fraud.
sexist right now.
I am saying the examples are wrong, because a woman is not encouraged to build, right, as a kid. So I think that should start. And this shopping therapy is largely oriented at women saying, go, should do shopping and you will relax. I think it's nonsense. I don't think it works for men or it works for women. And my book, I started by saying, invest rupees 40 a day. Because when you go to a kid who's say 24 years of age and you say put away 10,000 rupees a month on retirement, he's going to say, look, I've got other priorities, right? I've got to buy a motorbike, I've got to buy a car and things like that. But at 40 bucks a day, he's saying, wow, this is less than the price of a coffee, right? So 40 bucks a day, how much does he have by the time he's 60? Well, he's a 4 crores. That's not bad at all, because he started at 24. Now, if you ask him to bump it up by 10%, how much does he have? He has 13 crores. Right? So it's just that, you get up in the morning and brush your teeth. It's not a matter of discipline, it's a matter of habit.
You can't
so your
invest,
investing has to become a habit.
but you can't invest 40 rupees a day in equities, right?
Effectively, you have to do a mutual fund with 1200 rupees SIP.
Yeah.
Not very difficult
Which
to
is
do.
not very difficult to
So
do.
1200 rupees, you do an SIP, pick an index fund, pick up any fund, but start. That's the most important thing.
Okay.
If you sit in a place wondering which is the road to take, you will reach nowhere. At least you start with an index fund, then you know how to invest. Then you took it a large cap, mid cap, debt fund. You start looking at it later, but at least start. When you're 22, 23, start.
Okay. Now, we've established a few rules. Just before we wrap up the show, a few points from a mutual fund investor's perspective. Let's say people are convinced that this is how I want to do. This is how I want to plan my personal finance. So this is the personal finance lessons that we've given. I want to use mutual funds using this. You've given some examples of the equity and the debt allocation. A 25-year-old or a 30-year-old investing has a 20-year cycle ahead of him. Is everybody, and all through the last 2 years that we've done the mutual fund show, everybody said that if your time horizon is northwards of 8-10 years, then don't even think of debt investing. Invest in equities, because cycles have shown that equity investing will do well over a period of time. Then is it a no-brainer that start big in equities, think of debt after a period of time if your time horizons contract?
See, I mean, you know, everybody loves this, and I buy it completely, that you have 20 years, you have to do equity. But the reality is we are all human, you know. You have equity market corrections. Now, when you're 20, 25, 30, your tolerance for heart attacks and roller coasters in life is generally a little higher, and which is why I said the portfolio has to be equity biased or equity lopsided, I would go. But retirement is a process, right? It's not something you start at 30. As you get older and older, you will have cash flow needs. So in your 40s, you may be wanting to upgrade your house. You have to pay for that kid's education. So you will have capital that's short term. Your appetite to take severe drawdowns will definitely come down, which is where fixed income plays a role. I've always been, no matter how much of an equity bull you are, both complement each other. Both have to be a part of your portfolio, which is why the lifestyle-based allocation is what we've always recommended to people, that have some equity, have some fixed income. As you get older, fixed income becomes bigger.
I have a question. I'm a salaried person. I have employee provident fund getting deducted from my salary every month. Do I take a larger than a lopsided portfolio into equities because I have a 20-year earning horizon?
Yeah, because see, what is happening is, like what Radhika said, after $100, she wants you to put 20-30 rupees into debt, maybe 20 rupees and 80 in equity. That's
Do you
fine.
second that view?
Absolutely,
Okay,
but I'm
great.
saying that the 20 is already met by your PF. Then you can go 100% equity here, because overall your portfolio would still be 80-20. So exactly you're working as well. But I would, in a retirement plan, I would suggest that you at least consult with an advisor, and maybe you outgrow the advisor in 5 years. By the time you've learned, and then you don't need an advisor. But don't go, bullheaded and say, no, I will go without an advisor. It's sometimes very difficult. So start off with an advisor. Afterwards, you decide. When you have learned, you decide you don't need an advisor. It's a different thing. But at least start off with an advisor. Don't make a mess of it. And suppose you put all the money and then you require money for your wedding, which is happening in 3 years, then that would be a bad asset allocation.
Okay.
So
Okay, quick
don't do
30-second answers from both of you, because we're running out of time completely. Subra, to you first. Let's assume people are convinced equity mutual funds the way to go. 20-year horizon. Go for mid-cap, small-cap funds because they tend to outperform large caps over a 20-year period, or no such rule?
No, I wouldn't. I wouldn't
mix,
put such
a judicious mix?
Judicious mix, 50, 30 and 20 in small cap, 30 in mid cap and 50 in large cap will also work similar.
50, 30, 20.
Yeah, something like that will also work. So it's not to say that this will work or that will work.
Okay.
Because we don't know, we put money in all three, and then as time goes by, you keep correcting whatever if you want to take corrective action.
Okay, Radhika, your thoughts?
Basic multi-cap fund, I think, does exactly what he says, allocates between all three, takes advantage of it, is just enough for most people.
Okay, great. So, well, there you have it. Thank you so much, both of you. This was, well, an eye-opener for a lot of us, including me, doing this show as well. But appreciate you taking the time out and being with us today and giving us this wonderful piece of knowledge. And viewers, thanks for tuning in to the Mutual Fund Show. I know we haven't been able to answer some of your queries, but via this show, I think we've answered most of the queries that you would have had. If we still haven't managed to do that, please write into us. And I commit to you that we'll try and reply to your queries over the period of the next 7 days. With that, it's a wrap on the Mutual Fund Show.